Ford has just dropped a bombshell on the U.S. auto industry, and it's sending shockwaves across dealerships nationwide. Massive discounts on some of Ford's older model trucks have suddenly hit the market, and dealers are scrambling to make sense of what this really means. Customers are walking into showrooms and finding price tags slashed by thousands of dollars, something that hasn't been seen in years. But the big question is, why now? And why is Ford so desperate to move these trucks off their lots? The answer lies in inventory pressure. Ford has been stacking up unsold trucks from previous model years, especially as consumer demand shifts toward hybrids, EVs, and more fuel-efficient options. The market is brutal right now. Interest rates are high, buyers are cautious, and automakers are sitting on mountains of vehicles that just aren't moving fast enough. Ford's decision to slash prices isn't just generosity, it's survival. If these trucks don't move soon, the financial hit could be far worse than simply cutting prices. But here's where it gets interesting. The ripple effects across the auto industry are enormous. When Ford makes the first move in cutting truck prices, every other automaker pays attention. General Motors, Stellantis, Toyota, none of them can afford to look overpriced while Ford is dangling steep discounts in front of American buyers. It puts immediate pressure on the competition to follow suit. And once that domino starts falling, we could see a full-blown price war in the truck market. Dealers, already under stress, are panicking because sudden discounts destroy profit margins and reset customer expectations overnight. For buyers, this looks like the golden moment they've been waiting for. But is it really that simple? Sure, you could walk into a Ford dealership right now and score a deal on an F-150 or Ranger from the previous model year, saving thousands. But those discounts come with a catch. Older tech, lower resale value, and the knowledge that a newer version of the same truck is sitting right next to it on the lot. That means the deal you think you're getting today might feel outdated in just a couple of years. And for Ford itself, the impact is double-edged. On one hand, clearing out inventory keeps the production line moving and generates short-term cash flow. On the other hand, slashing prices sends a signal of weakness to both Wall Street and the broader industry. Investors hate to see discounts this steep because it screams that demand isn't where it should be. For Ford, this strategy could either stabilize the company through a rough patch or trigger a dangerous race to the bottom that eats away at profits long-term. Another layer to this story is the psychological impact on buyers. When customers see Ford cutting prices so aggressively, many start wondering if they should even pay full price for a new truck at all. Why spend $55,000 on the latest model when a similar one is suddenly being offered for $10,000 less just because it's a year older? This mindset is dangerous for Ford and for the entire industry, because once consumers get used to discounts, paying the sticker price becomes a thing of the past. Dealers hate this trend because it erodes their negotiating power and kills the urgency to buy at launch. Meanwhile, competitors are being forced into a corner. GM has already been facing pressure with slowing Silverado sales, and Ram is heavily discounting its outgoing models to prepare for new releases. Ford's decision just accelerates the squeeze. If Chevy or Ram don't respond with similar price cuts, they risk losing buyers who are simply chasing the cheapest deal. And if they do match Ford's discounts, suddenly every truck on the market loses value overnight. This could trigger the most aggressive truck price battle we've seen in over a decade. The timing also raises eyebrows. Ford isn't doing this out of charity. It's strategic. With 2026 models around the corner, Ford needs to clean out its inventory now, or dealers will be forced to sit on outdated trucks that get harder to sell each passing month. Old inventory means locked up cash, bloated lots, and a dangerous drag on future sales. By offering these steep discounts, Ford is essentially admitting that the demand isn't strong enough to clear the old stock at regular prices. That's a big warning sign for the state of the U.S. truck market overall. But here's the twist. While dealers are panicking about their margins, Ford corporate might actually be betting on volume. Selling thousands of trucks at a discount could look better on paper than letting them sit unsold. It's a gamble. Sacrifice profit per truck in hopes of stabilizing total sales figures. Yet, this tactic doesn't come without risk. The more Ford discounts now, the more buyers will hold off in the future, waiting for the next big clearance sale instead of buying new. It's a cycle that can spiral out of control if not carefully managed. There's also the question of brand image. Ford has spent decades building the F-150 into America's most iconic truck, a symbol of strength, reliability, and dominance. But when the same trucks are suddenly being pushed out the door at fire sale prices, it risks cheapening the brand. Customers start asking themselves, if Ford is willing to slash prices this much, were the trucks overpriced to begin with? That doubt alone can chip away at brand loyalty, especially when rivals like Toyota and Ram are watching closely, ready to spin the narrative in their favor. Investors, too, are on edge. Wall Street has been laser-focused on how traditional automakers transition into the EV era. But this wave of discounts highlights a bigger problem. Traditional truck demand may be slowing faster than expected. If Ford can't sell gas-powered trucks without slashing prices, it signals weakness in their core business, the very foundation of the company's profits. For shareholders, this looks less like a strategy and more like a warning sign of tougher times ahead. If quarterly earnings show shrinking margins because of these discounts, Ford's stock could take a hit, and that will only put more pressure on management to prove they have a long-term plan. And let's not forget the buyers who already paid full price. Imagine spending $55,000 on a truck last year, only to see the same model being offered for $10,000 less today. That leaves a bitter taste for loyal customers who thought they were making a smart investment. It can even drag down resale values, as the used market adjusts to the lower pricing baseline. That frustration among existing owners can hurt Ford's reputation just as much as the discounts help move new inventory. For the wider truck market, the ripple effect is massive. Trucks aren't just vehicles. They're the bread and butter of Detroit's Big Three, the most profitable segment by far. If Ford's aggressive price cuts trigger a domino effect, every automaker could be forced into slimmer margins, weaker profits, and a scramble to keep sales afloat. It's the kind of pressure that could reshape the U.S. auto market for years to come. What happens next is where things get even more unpredictable. If Ford extends these discounts beyond just clearing old inventory, it could permanently reset the pricing structure of the truck market. Buyers will begin to expect deals year-round, not just during clearance cycles, and that expectation forces automakers to rethink how they price, market, and launch new models. This could push the industry into a dangerous cycle where nobody wants to buy a truck at full price, waiting instead for the inevitable markdowns. Competitors are watching closely. GM could be the first to respond with Silverado discounts, since its own dealers have been struggling with excess stock. Ram, too, can't afford to ignore Ford's moves if it wants to keep market share in the U.S. pickup segment. Even Toyota, known for holding strong on pricing with the Tacoma and Tundra, might be pressured to throw in incentives just to stay competitive. If all of them jump into this price cut battle, we could see a wave of deep discounts across the entire truck industry, something that hasn't happened in decades. For buyers, the short-term outcome looks fantastic: cheaper trucks, better deals, and more negotiating power than ever before. But long-term, it could come at a cost. If profits collapse across the industry, automakers might cut back on research, innovation, and quality in order to protect their bottom line. That means trucks 5 or 10 years from now could end up with fewer advancements, fewer trim options, or even higher prices on new technologies as companies try to make up the difference. At the dealership level, panic is already setting in. Many dealers rely on higher truck margins to keep their businesses afloat, and when those margins vanish, it creates real financial strain. Some dealerships may not survive prolonged discounting if it continues at this scale. The tension between automakers pushing discounts to move metal and dealers needing profit to survive is boiling over, and it could lead to a showdown within the industry itself. The dealership battle is perhaps the most overlooked part of this entire shakeup. Dealers have been the backbone of Ford's sales network for over a century, but massive discounts threaten that relationship. When corporate slashes prices, dealers lose the flexibility to pad margins, offer competitive financing, or sweeten trade-in deals. Instead, they're left scrambling to make up revenue through service departments, warranties, or accessories. That's not a sustainable model when trucks, once the most profitable items on the lot, are suddenly being sold at bargain bin prices. And this friction could push the industry toward a radical change: direct-to-consumer sales. Companies like Tesla have already proven that bypassing dealerships can work, And if Ford's discounts keep bleeding dealer profits, pressure will mount to adopt a similar approach. Imagine ordering your next F-150 online directly from Ford, skipping the dealer entirely. For buyers, it sounds convenient. For dealers, it's a nightmare scenario. And this wave of discounts could be the spark that accelerates that shift. Meanwhile, Ford's rivals aren't just watching, they're strategizing. GM knows that if Ford normalizes steep markdowns, Silverado sales are in immediate danger. Ram has been hanging its hopes on fresh redesigns, but if Ford floods the market with cheaper trucks, Ram's new models could lose their shine before they even hit peak demand. Toyota, the outlier, has built its reputation on strong resale values and minimal discounts. But even Toyota won't be immune if buyers start walking into dealerships asking, "Why isn't your truck discounted like Ford's?" This competitive pressure could force Toyota into rare territory, something it has avoided for decades: big price cuts. And let's not forget the buyers caught in the middle. For someone in the market for a truck today, these discounts look like a once-in-a-lifetime opportunity. But there's also the risk of waiting too long. If Ford's current fire sale triggers a market-wide price war, the best deals might be just a few months away. On the flip side, if inventory clears out faster than expected, the window for these massive savings could slam shut. Buyers are now left trying to time the market, which has never been more uncertain than it is right now. The long-term truck market could face a collapse if this spiral continues unchecked. One of the biggest dangers lies in resale values. Trucks have traditionally held their value better than most vehicles, especially Ford's F-Series, which has been a symbol of stability for decades. But the second Ford starts offloading brand new trucks with huge markdowns, the used market reacts instantly. Suddenly, a 2-year-old F-150 is worth thousands less because buyers know they can get a newer one at nearly the same price. That devalues every truck already on the road and makes leasing less attractive, since residual values take a hit. This depreciation ripple doesn't just affect owners, it shakes financing, leasing companies, and even insurance firms. Lenders rely on predictable resale values to structure loans. If truck prices collapse, banks and finance companies face greater risk, which could tighten credit and make it harder for buyers to get approved. Insurance payouts on totaled trucks could shrink too, because lower resale values mean lower replacement costs. What looks like a deal today could actually destabilize the entire financial ecosystem that props up the US truck market. At the same time, Ford's ambitions for the EV transition hang in the balance. The company has been pouring billions into electric trucks like the F-150 Lightning, betting that future profits will come from electrification. But if Ford is forced to burn cash clearing out old gas-powered models, it weakens their ability to invest aggressively in EVs. That's dangerous, because Tesla, Rivian, and even GM are moving fast in the EV space. If Ford's balance sheet gets weighed down by discounted inventory, their EV rollout could stall, leaving them vulnerable in the very segment that's supposed to secure their future. And let's not forget investor psychology. Wall Street doesn't just look at sales numbers, it looks at margins. A discounted truck may help Ford boast about sales volume, but investors see right through it. They'll want to know how much profit Ford actually kept per vehicle. If margins collapse, stock prices could follow. That puts pressure on leadership to either justify this strategy as a short-term move or face serious doubts about Ford's long-term competitiveness. The company's credibility is on the line. If Ford's discount blitz sets the tone, the fallout across the auto industry could be seismic. GM, for instance, has long depended on the Silverado and Sierra as profit machines. But if Ford drags average transaction prices down, GM has no choice but to follow. That means slimmer margins on vehicles that were once the financial backbone of the company. Stellantis, with its Ram lineup, faces a similar trap. The brand has been pushing aggressive redesigns and flashy trims to stand out, but discounts on F-150s and Rangers could force Ram to sacrifice profitability just to keep buyers interested. Even foreign automakers who have historically struggled to dominate the US truck market are watching carefully. Toyota and Nissan have always positioned themselves as premium-priced but reliable alternatives. If Ford normalizes huge markdowns, Toyota's long-standing refusal to play the discount game comes under fire. The Tacoma and Tundra are built on their reputation for holding value. But if Ford convinces buyers they can save thousands by going blue oval, Toyota may be forced to bend its rules and dive into incentives it has avoided for years. That shift alone would be historic. On the global stage, the ripple effects are just as concerning. The US pickup market is one of the most profitable segments in the world, and it funds massive portions of R&D for automakers. If margins collapse here, the impact could stretch far beyond trucks, slowing innovation in SUVs, EVs, and even autonomous technology. A truck price war doesn't just lower sticker prices, it could stall the entire industry's progress for years. And what makes this moment even more dangerous is timing. The industry is already juggling supply chain instability, high interest rates, and the costly transition to electrification. Ford's decision to pull the discount trigger at this exact moment could either be remembered as a bold survival tactic or the first domino in a chain reaction that rewrote the rules of the US auto market. Consumer behavior may never return to what it was before these discounts. Once shoppers see trucks slashed by thousands of dollars, they begin to rewire their expectations. Why rush to buy at launch when patience pays off with massive savings? This new mentality could slow down early adoption of new models, hurting the excitement and profitability that automakers rely on during those first critical months after a release. Buyers may also begin to prioritize deals over loyalty. For decades, Ford has benefited from generational brand trust, families buying F-150s again and again. But loyalty erodes quickly when price becomes the main driver. If a Chevy, a Ram, or even a Toyota suddenly offers a bigger discount, buyers will jump ship. Discounts transform trucks from emotional purchases into commodity products, where the lowest price wins. That's a dangerous shift for an industry that has always sold lifestyle and image as much as utility. Premium trims are especially at risk. Trucks loaded with leather interiors, advanced tech, and premium sound systems once justified eye-watering price tags because they projected status. But if discounts flood the market, buyers might abandon those trims altogether, reasoning that a cheaper mid-tier model delivers most of the same capability at a fraction of the cost. That undercuts one of the most profitable slices of the truck market and forces automakers to rethink their entire trim strategy. And while the short-term result is trucks being more affordable to the average buyer, the long-term risk is stagnation. Automakers will have less incentive to innovate if they're forced to fight price wars year after year. Instead of introducing groundbreaking features, they may cut corners to protect margins, leaving future trucks less advanced than buyers expect. What feels like a win at the dealership today could become a loss for consumers down the road. Government policy is another storm cloud hovering over this price war. Federal fuel economy standards and state-level emissions targets are tightening, forcing automakers to invest billions into cleaner technologies. But if Ford and its rivals are busy slashing profits just to move old inventory, where will that money come from? Discounts might move trucks today, but they drain the war chest needed for tomorrow's regulatory battles. If companies can't afford to keep up with stricter rules, they risk fines, compliance costs, or falling behind in the global EV race. Labor costs add even more pressure. After last year's union negotiations, Ford, GM, and Stellantis all agreed to higher wages and benefits for their workers. That deal was historic, but it also raised the baseline cost of building vehicles. Every truck that sells at a steep discount eats into those higher costs, squeezing profits thinner than ever. Dealers may be panicking, but so are executives who know the math doesn't add up long-term. It's a recipe for plant slowdowns, delayed launches, and even potential layoffs if the cycle doesn't break. Then comes the EV transition. Ford is banking on the F-150 Lightning to anchor its electric future, but discounting gas-powered models muddies the waters. Why would buyers pay a premium for an electric truck when its gas sibling suddenly looks like a bargain? Ford risks undercutting its own EV momentum, just as rivals like Tesla and Rivian are ramping up production. If the Lightning stalls, Ford's broader EV strategy could unravel, leaving the company exposed in the very market segment it hoped to dominate. The volatility of these combined forces policy, labor, and electrification means Ford isn't just playing with pricing. They're playing with the very foundation of their business. One wrong step, and the fallout won't just hurt dealerships or buyers, it could reshape Ford's future for an entire generation. The worst-case scenario is something the auto industry doesn't even want to whisper about. If discounts spiral out of control, Ford could be forced into painful plant shutdowns. When production slows, it doesn't just affect the factory floor. It ripples outward to parts suppliers, logistics companies, and even small businesses that depend on auto plants for survival. Whole communities in Michigan, Ohio, and Kentucky could feel the squeeze if Ford trims shifts or halts production altogether. Dealers face an equally grim outlook. Many are already stretched thin from years of fluctuating inventory and tight credit markets. If discounts continue to crush margins, smaller dealerships could face bankruptcy. That means fewer local points of sale, less service coverage, and a weaker connection between Ford and rural or suburban buyers. Losing dealers isn't just a numbers game. It's a blow to Ford's long-standing presence in America's heartland. And then comes the possibility of a full-blown collapse in truck demand. Trucks have always been seen as recession-proof, but what if buyers collectively hit pause, expecting deeper discounts ahead? If consumers refuse to buy at today's prices, Ford and its competitors could be stuck with a dangerous glut of vehicles. That kind of inventory freeze would force even more discounts, destroying residual values and sparking a vicious cycle where nobody wins: buyers, dealers, or automakers. The scariest part? Once consumer trust in pricing evaporates, it's nearly impossible to restore. Even if Ford stabilizes in the short term, the psychological shift among buyers could linger for years, permanently lowering the ceiling of what Americans are willing to pay for a new truck. That's not just a problem for Ford. It's a crisis for the entire U.S. auto industry. At the end of the day, Ford's massive truck discounts are more than just a sales tactic. They're a turning point. This bold gamble has shaken the auto industry to its core, leaving dealers anxious, competitors scrambling, and buyers wondering if they should act now or wait for even deeper cuts. Whether this move becomes Ford's lifeline or its biggest misstep depends on what happens next. For the auto industry, the message is clear. The old rules no longer apply. Discounts this steep don't just move inventory, they change buyer psychology, reset market expectations, and force every automaker to reconsider its future. The next few months could determine if this price war becomes the new normal or a one-time shockwave. And for you, the buyer, the opportunity is real, but the risks are just as high. A discounted truck might save you thousands today, but it could also reshape the value of your purchase tomorrow. The question isn't just whether you can buy one of these trucks now, it's whether you should.